Okay, imagine this. A company, not even 3 years old, is suddenly worth $32 billion. Its founder, a young genius, hailed as the next Warren Buffett, who tells everyone his only goal is to save the world. Now imagine all of it. The money, the fame, the mission, all of it just vanishes in 10 days. It's a real-life financial thriller, and it all kicked off because of one secret document that was never, ever supposed to get out. So how did this happen? How did everything go so wrong so fast? Let's get into it. So at the very center of this whole storm is a guy named Sam Bankman-Fried, or as pretty much everyone calls him, SBF. And look, he was not your typical CEO. We're talking messy hair, cargo shorts, famously sleeping on a beanbag chair at the office. He was this perfect icon for a new age of finance. And the crypto empire he built, FTX, felt absolutely unstoppable. It was marketed as the safe bet, the regulated, responsible adult in the wild west of crypto. And this quote, this was the core of his entire public image. SBF went out of his way to tell people he just wasn't interested in being rich. He told Bloomberg News he'd already bought everything that could make him happy. This whole persona was the humble crusader, the anti-billionaire billionaire. He wasn't in it for the money, he was in it for the greater good. And man, it was a story people desperately wanted to believe. But here's the thing, this image was backed up by some seriously impressive credentials. We're talking a degree in physics from MIT. After that, he lands a job at Jane Street, which, if you don't know, is this legendary, super elite trading firm that's almost impossible to get into. So this background gave him this aura of being a true genius. He wasn't just some random guy who got lucky with crypto. He was a brilliant quant who saw the markets in a way the rest of us just couldn't. And this was his supposed guiding light, his moral compass. SBF was a huge promoter of this philosophy called effective altruism. And his particular flavor of it was something called earning to give. The idea is actually pretty simple. Don't go work for a charity. Instead, go into a field like finance, make an absolutely obscene amount of money, and then just give it all away to the world's most effective causes. See? He wasn't getting rich for himself, he was getting rich for all of humanity. And oh boy, did he get rich. In just 3 years, his crypto exchange, FTX, just exploded onto the scene. By early 2022, it was valued at a jaw-dropping $32 billion. We're talking over 1 million users, huge trading volumes, and backing from some of the most respected names in finance. FTX was positioned as the safe harbor, the one giant you could actually trust. Right, so behind the brilliant MIT grad, behind the noble philosophy, behind that massive valuation, a very, very different story was playing out. And that whole carefully built image was about to collide with the secret that would bring the entire thing crashing down. You see, this whole thing didn't start with some big market crash or a government raid. Nope, it started with a single news story from a crypto publication called CoinDesk. They got their hands on a private financial document, a balance sheet, and it revealed a fatal crack right in the foundation of SBF's entire empire. Now here's the twist. The document wasn't even from FTX. It was from a crypto hedge fund called Alameda Research. Alameda was presented to the public as a completely separate company, but it had one huge thing in common with FTX. It was also founded and secretly controlled by Sam Bankman-Fried. They were supposed to be two different entities, but as we're about to see, their finances were tangled together in the worst way possible. So at first glance, you look at this balance sheet and everything seems pretty good. Alameda Research is sitting on $14.6 billion in assets. I mean, for a hedge fund, that's a huge amount of capital. It looks like a powerful, stable, successful firm. But as they say, the devil is always in the details. And when reporters looked closer at those details, they found something really strange. The single biggest asset on Alameda's books, it wasn't Bitcoin, it wasn't Ethereum, it wasn't US dollars, a massive chunk of its foundation, almost 40%, about $5.8 billion worth, was all in a token called FTT. And what, you ask, was FTT? Well, it was the crypto token created by its sister company, FTX. Yeah, FTT wasn't like Bitcoin with a decentralized network. It was an exchange token that FTX basically printed out of thin air. The best way to think about it is, it's not really money. It's more like a store coupon or airline miles. If you held FTT, you got discounts on your trading fees on FTX. That's it. Its entire value was based on one thing: people believing that FTX was a trustworthy and successful company. Okay, now this is where the story goes from weird to completely insane. It turns out that SBF's two companies, FTX and Alameda, together controlled the vast majority of all the FTT tokens out there, like around 90% of them. This means there was no real market. The price wasn't being set by thousands of people buying and selling. It could be propped up by the very people who created it. And this brings us to the central, terrifying question of this whole saga. How on earth can a hedge fund take a pile of its own homemade loyalty coupons and use them as collateral to borrow billions of dollars in real money? The leak revealed that the entire empire was a house of cards. It was a ticking time bomb. If the value of that FTT coupon ever dropped, that $14.6 billion foundation would just vaporize. So that CoinDesk article didn't just light a fuse. It was like throwing a match into a tanker truck full of gasoline. The secret was out. The whole market now understood the reality. SBF's empire was built on a token that he himself printed. And what came next was one of the fastest, most brutal financial collapses in modern history. It all happened so fast, it was hard to keep up. On November 6th, the CEO of Binance, FTX's biggest rival, tweeted that he was selling all of his FTT. That was the first domino. Panic. Absolute panic. Customers scrambled to pull their money out of FTX in a classic bank run. But guess what? The money wasn't there. By November 8th, FTX slammed the brakes and halted all withdrawals. A last-ditch rescue deal fell apart a day later, and by November 11th, it was over. The $32 billion company was officially bankrupt. Right in the middle of all this chaos, Alameda CEO Caroline Ellison made this desperate public move. She actually tweeted an offer to buy all of Binance's FTT tokens for a flat price of $22 each. Now, instead of calming people down, this did the exact opposite. Everyone in the market immediately saw this as a giant red flag. It basically screamed, our entire company will collapse if FTT's price falls below $22. It was a public admission of just how fragile they were. I mean, the sheer speed and scale of this collapse is just staggering to think about. One week, Sam Bankman-Fried is on the cover of magazines, he's talking to presidents, he's the king of crypto. 10 days later, his $32 billion empire is worth absolutely zero, a complete and total implosion. So, once FTX filed for bankruptcy, the story completely changed. It went from a fast-moving market crisis to a slow, deliberate, forensic investigation. The professionals stepped in to sift through the wreckage, and what they started to uncover was so much worse than anyone had even imagined. The court brought in a new CEO to handle the bankruptcy, a guy named John J. Ray III. And you have to understand, this guy is a legend in corporate cleanups. He's the man who handled the liquidation of Enron. The moment he was appointed, everyone in the financial world knew just how bad this was. He would later go on record saying that in his entire 40-year career, he had never seen such a complete failure of corporate controls, not even at Enron. And Ray's team just started uncovering one shocking failure after another. First, customer money and company money were all mixed together in one big pot, and Alameda was using that customer money for its own incredibly risky bets. It turns out, FTX had built a secret backdoor in its own software, a feature that gave Alameda a nearly limitless $65 billion line of credit, all funded by FTX customers without them knowing. And on top of all that, more than $1 billion in loans were given directly to SBF and other top executives. So when all the digging was done, they found the total price tag for this fraud: $8 billion. That's how much customer money had just disappeared. It wasn't lost in a bad market. It was taken, it was diverted, and spent on risky investments, luxury penthouses in the Bahamas, and massive political donations. For the million-plus people who trusted FTX, their money was just gone. Well, the legal fallout came fast. Sam Bankman-Fried was arrested in the Bahamas and brought back to the U.S. And the big break for the prosecutors came when his closest allies, his inner circle, including Caroline Ellison and the co-founder of FTX, Gary Wang, they all pleaded guilty. And they all agreed to cooperate and testify against him. After a month-long trial, the jury didn't take long. They found him guilty on all 7 criminal counts. For pulling off one of the largest financial frauds in American history, the boy genius who promised to save the world was sentenced to 25 years in federal prison. The judge called out his feigned altruism and said he lied repeatedly on the witness stand, showing absolutely no remorse for the lives he'd ruined. You know, the story of FTX is so much bigger than just one company or one guy. It's really a cautionary tale that leaves all of us with a really tough question. The whole promise of crypto was a new financial system, one without the old rules and the old gatekeepers. But what the FTX saga proves is that without any oversight, without basic rules, the potential for massive fraud is just off the charts. So as we all try to figure out this new digital world, the biggest question isn't about code or technology, it's about a much older, much more human concept: trust. And who, if anyone, has actually earned it?